Welcome back to The Deep Dive. Today we're digging into Heritage Insurance Holdings, HRTG, specifically their second quarter 2025 earnings call. And what we found is this really stark disconnect, maybe the most confusing one we've looked at all year.
It really is. A total study in market skepticism versus, well, pretty flawless operational execution, wouldn't you say?
Absolutely.
Management delivered a huge GAAP EPS beat. Came in at $1.55 per share.
Right, and consensus was hovering around $1, maybe 98 cents.
Exactly. So that's what, a 55 to 58% beat on profit. Huge. But the market just hammered the stock. Double-digit drop on really heavy volume.
Yeah, that's the core paradox, right? That's what we need to unpack here. The company's signaling this clean, successful operational turnaround. But investors, they reacted like it was a disaster. So was the market right to be cautious, because of that top-line revenue miss and maybe the general macro risk for coastal insurers? Or did everyone just completely miss the quality that was actually in this quarter?
Yeah, that's our mission today. Let's dissect that divergence. Is HRTG a successful turnaround story, or is it a stock priced for perfection just as hurricane season ramps up?
Okay, so let's hit the snapshot first. Those results again.
Well, the EPS figures, like we said, $1.55. Hard to argue with that. Net income rocketed up 155% year over year, came in at $48.0 million.
Which translates to a, 23% profit margin for the quarter?
23%, just massive profitability.
Stunning numbers, really feels like deep structural change is happening there. But like you said, the caution came from the top line.
That's the rub. Total revenue was $208.0 million. Consensus was looking for maybe $214 million, $216 million.
Miss, but a relatively small one, 2 to 4%.
Yeah, modest miss. But year-over-year revenue growth was only 2.2%. Very slow.
And that's where the market dug in its heels.
That seems to be it. Despite the record profit, the stock fell, 12.2% right away?
What?
That kind of reaction tells you just how sensitive investors are right now. Any whiff of slowed growth, any uncertainty, especially for a stock like HRTG that had already run up so much in the past year.
Yeah, the bar was set incredibly high, wasn't it?
Exceptionally high. Okay, so let's dive into the quality story, because this is what management really wants everyone focused on. Underwriting discipline.
Right, the core of any insurer. And the key number here is the combined ratio.
And HRTG delivered something pretty special on that front.
What was the number again?
The combined ratio, that's your losses plus expenses divided by the premiums you earned, it collapsed down to 72.9%.
72.9.
Yeah.
In coastal P&C insurance, that sounds legendary.
It's an incredible number. It marks a massive 19.6 percentage point improvement from the 92.5% they reported just last year.
Okay, let's break that down for listeners maybe not steeped in insurance jargon.
Yeah.
72.9%. What does that mean in simple profit terms?
Okay, simple terms. If your combined ratio is 72.9%, it means for every dollar of premium you collect, you're only spending about 73 cents on claims and all your operating costs.
Okay.
So that leaves a 27.1% underwriting profit margin. That's pure profit just on the insurance side, before you even count investment income.
27% underwriting margin.
Yeah. That level of efficiency is, frankly, almost unheard of in this specific sector, especially from a company that not too long ago was really wrestling with some bad loss trends.
Okay, but let's push back a bit here. Be skeptical. HRTG spent years deliberately shrinking, right? They shed, over 200,000 policies since 2021?
That's right. A very intentional contraction.
So aren't they just insuring the absolute safest, lowest risk policies left? Is this 72.9% combined ratio really sustainable? Or is it just a temporary snapshot of a perfectly cherry-picked portfolio?
That's the million-dollar question, isn't it? And, well, according to management, the answer is it's more than just policy selection. It points to structural changes. Real execution.
Okay, how so?
Well, first, look at the net loss ratio. It improved by a huge 17.2 points, down to 38.5%.
Okay, 17 points improvement. But how much of that was maybe a one-time cleanup versus something repeatable day in, day out?
Well, a critical piece was this swing in reserve development. This quarter, they actually had $2.3 million in favorable reserve development.
Meaning they'd set aside too much money before.
Exactly. For claims that didn't end up happening. That's a positive sign about how they were booking business in prior years.
Yeah.
And crucially, compare that to last year's Q2, where they had $8.7 million in adverse development. So money they hadn't set aside but needed.
So that's a huge swing. Over $11 million difference just on reserve adjustments between the 2 years.
Precisely. That massive swing really helps clean up the earnings profile. It suggests past problems are genuinely being put behind them.
Okay, what about weather? That's always the wild card, especially in Florida and along the coast.
Yep, net weather and catastrophe losses were $12.5 million. Now, that's actually down $7.2 million from last year's quarter.
Lower cat losses. Was that just luck? Or strategy?
Management was pretty quick to say it wasn't all luck. They attributed it partly to their tighter underwriting, selecting better risks, requiring newer roofs, diversifying the book geographically so they're less exposed to, say, one big hailstorm somewhere.
So the discipline is actually reducing volatility, not just avoiding bad risks entirely.
That's the argument. And we also saw the expense side help too. The expense ratio improved 2.4 points, down to 34.4%.
How'd they manage that?
Two things, mainly. First, growth in net premiums earned helped spread the costs. And second, they got higher ceding commission income from their reinsurance program, their quota share deal.
Okay.
So management's message was clear. This quarter wasn't an accident. It was underwriting discipline, expense control, validating this multi-year strategy shift. They feel the underlying loss trend, the attritional loss trajectory, is finally stabilizing for good.
And they specifically called out legislative reforms helping.
Yes, especially in Florida.
Yeah.
Reducing frivolous lawsuits, that seems to be having a real impact.
Okay, so this brings us to the next big question. They seem to have fixed the profit engine. That 72.9 CARR is proof. But now, can they actually grow again without wrecking that profitability? After years of shrinking away from risk.
They are, it seems, right at that inflection point. Like you said, they shed over 200,000 policies since 2021 started this contraction. This quarter, the decrease in policies in force, PIF, was only 7,700.
Okay, only 7,700. That's the smallest drop in years.
By far. That tiny decrease is the signal. It's the pivot to what they're calling managed growth.
Managed growth, not just opening the floodgates.
Exactly. And new business production. That's already ramping up. It increased 46% year over year this quarter.
46% increase in new business? Okay, that's significant.
It is. And their forecast is pretty aggressive, actually.
Yeah.
Management expects PIF to basically flatten out, maybe tick up slightly in the second half of this year, 2025, and then accelerate sharply in 2026. That's when they expect all their territories to be fully open for business again. They said they're about 95% open now.
Right. So where's that new momentum coming from? Which areas are driving this new business, and are they still finding quality risks there?
It seems pretty regional right now. They highlighted really strong new business trends up in the Northeast, New York specifically, and also the Mid-Atlantic, with Virginia leading there.
Interesting. And not just Florida, then.
Not just Florida, although Florida is still critical. It used to be their big headache, obviously. But these recent legislative reforms seem to be making it profitable again, mainly by cutting down on those lawsuits we mentioned.
So Florida might become a growth engine again. Carefully managed, perhaps.
That seems to be the plan. Carefully managed growth there, too.
Okay, growth takes capital, especially if you're expanding back into coastal areas, even carefully. How's the balance sheet looking?
Well, book value per share jumped significantly. It's up to $12.36 now. That's up, get this, 48.6% year over year.
Wow, nearly 50% increase in book value. That's strong.
Very strong. And maybe a key signal of external confidence came right after the quarter ended. They refinanced their main credit facility.
Okay, what changed there?
They upsized the capacity from $150 million up to $200 million. They extended the maturity way out by 5 years to 2030. And importantly, they got better terms.
That last point, better terms. That's crucial, isn't it? It means the banks lending them money see HRTG as a fundamentally less risky company now compared to just a year or two ago.
That's exactly the signal it sends. Plus, their statutory capital, the capital regulators really watch, is up $76.6 million year over year.
Okay, so that provides the buffer, the capacity needed for that growth acceleration they're planning for 2026.
Right. They also seem to have stabilized their risk profile. They've fully placed their big catastrophe reinsurance program for 2025-26. And they added a new servicing partnership in Hawaii through their subsidiary Zephyr, working with the Hawaii Hurricane Relief Fund, so diversifying a bit there too.
Okay, so let's pull this together. We have a company showing record operational quality, that 72.9 TOCAR, a much stronger balance sheet, a clear plan to accelerate growth into 2026. Why on earth did the market react with a 12% stock drop? What explains this huge disconnect?
I think it boils down to basically two things: valuation and fear.
Okay.
Management is executing this textbook turnaround, focused laser-like on margin quality. which is great. But the market, it seems fixated on that small top-line revenue miss.
Implying the growth pivot isn't quite showing up in the numbers yet.
Exactly. It's not visible enough yet. And the second factor, maybe overriding everything, is just the inherent fear baked into the coastal P&C sector as we head into peak hurricane season.
It's just such a high bar they have to clear, isn't it? Especially after the run HRTG stock had.
Absolutely. The stock was up over 75% in the year leading up to this call. Meanwhile, the broader insurance ETFs like IAK were basically flat, maybe up 1.5%.
Yeah.
So when you've had a run like that, investors demand perfection, not just on the bottom line, but the top line too, to justify that higher valuation multiple.
They needed proof the turnaround was truly done and the compounding phase had begun, and they didn't quite see it yet.
Didn't see it immediately. So the catalysts now are really about testing the repeatability of this profitability. Q3 results, any big hurricane loss updates through the season, that'll show whether this amazing 72.9 QRR is scalable as they grow.
Right.
Management tried to bridge that gap, though. They suggested these ongoing legislative changes in Florida might actually help lower their reinsurance costs in 2026, which would fuel more profitable growth. But that's still a maybe.
Okay, so what does this all mean for you, the listener, trying to make sense of this stock? You've got incredible operational improvement, but it's priced against high macro risk, a very demanding valuation after a huge run, and that slight revenue disappointment.
Just a classic setup for volatility, isn't it?
Seems like it.
If you believe the operational turnaround is real and structural, but you think the stock's immediate path might be bumpy because of these external factors, these high expectations, well, then you look for ways to maybe play that temporary overreaction or the high cost people are paying to insure against risk right now.
Okay, let's transition then. Our This Is Not Financial Advice segment, based purely on the dynamics we've discussed. What's a plausible, maybe even a bit outrageous trade idea to try and monetize this specific situation?
All right, teen off a time. So the setup is, company seems structurally much better, right? But the stock itself looks vulnerable, either to a big hurricane hitting the wrong spot or just vulnerability from the top line growth not quite matching the valuation yet.
Right, the premium valuation needs justification.
Exactly. So the idea here is something like a synthetic short strategy, designed to profit from this high market fear right now, but also capping your potential losses if the whole insurance sector keeps grinding higher for some reason.
Okay, a synthetic short. How would you actually structure that? Make it capital efficient, betting against this immediate price sustainability.
Well, one way is to look at selling a call spread, fairly far out of the money.
Selling calls, betting the stock won't go much higher.
Right. But a spread, so you define your risk. Why do this? Because with all this hurricane fear, option premiums, basically the price of insurance against the stock surging, they're really inflated right now.
High implied volatility.
Exactly. So by selling a call spread, maybe 6 months out, maybe even a year, you collect that inflated premium. You're essentially getting paid to bet that the stock won't break significantly higher from this already high level in the short to medium term. You monetize the fear premium.
Okay, I see the logic. You collect premium while you wait for the growth story to either fully prove itself or for the valuation to maybe settle down a bit. But what if you're wrong about HRTG specifically and the whole P&C sector just keeps rallying? Maybe the economy stays strong, global cat losses stay low. You don't want to get run over.
Good point. That's the hedge. You pair that short HRTG call spread with a small protective long position in a broad P&C sector ETF, something like IAK or KE.
Okay, so long the sector ETF.
A small position, yeah. IAK is probably the main benchmark ETF there. This hedges you against general insurance market strength. If the whole tide lifts all boats, your ETF position helps offset losses on the HRTG short call spread.
Got it.
So it keeps your core conviction that HRTG's specific valuation after that 75% run needs more time and proof for the 2026 growth story to really hit. But it controls your risk exposure if the whole sector moves against you. It's a precise bet on valuation decay, maybe, while managing the broader market risk.
An analytical, capital-efficient way to bet against gravity, perhaps.
Okay, so let's recap for you, the listener, the two absolute key takeaways from this HRTG deep dive. First, they have successfully shifted focus to operations. That stunning 72.9% combined ratio is the evidence.
Quality is validated, no doubt.
Second, they are now clearly at an inflection point. They're aiming for accelerated growth into 2026. But that growth story, it's still mostly a promise.
Right. The market priced in that promise before it really saw the proof in the top line numbers. Now management needs to close that execution gap.
Which leaves us with our final provocative thought for you to mull over. Management explicitly chose profit over volume for years. Now they're pivoting back to growth. How long will investors really tolerate a sort of moderate revenue growth rate before they fully buy into the idea that this turnaround story has successfully become a true compounder stock, deserving a top-tier valuation?
That patience or lack thereof is definitely going to be tested over the next couple of quarters, especially through hurricane season.
Indeed it will. Thank you for joining us for this deep dive.